welcome to episode 8 in the series of financial wellness webinars brought to you by Bank Windhoek. The last time we spoke about investing and we really zoned in on retirement planning. And I know retirement planning can feel really daunting, especially when you realize that you may stay alive for too long and that you may actually live longer than your money does. You might outrun your own money. And this really brings us to the next point, which is to really consider how important it is to plan for your own health, to consider yourself as your most important asset, as a future dependent of yourself, and to ensure that you actually make some provision for that. Yes, you do so by ensuring that you plan for retirement, planning for the later years, but that wouldn't be enough. You would also need to consider, how do I remain healthy? How do I make sure that as I live in retirement, with the knowledge that currently the first person who's going to live to the age of 150 is already born, how do I make sure that I have the best life in retirement? I have to take care of my health. You are your most important asset. You need to take care of you. And there are very many products out there that can really help you serve this purpose. Now, when we talk of protection of wealth, the first thing we generally look at is how do we make sure that should we no longer be around, those who depend on us do not, over and above having to deal with the emotional prejudice of your loss, also have to deal with the financial prejudice of the income that you used to bring into the household being completely annihilated. So of course, most of us take out what we call life cover to ensure that on the happening of a life event, which could be we die, or we become disabled, or we contract a severe illness, there is an amount of money that comes into play to cater for the loss that was experienced either through the loss of income with the person no longer being around, or the loss of income with the person no longer being able to go to work on a regular basis and bring that income home. So of course, here we prioritize ourselves as a future dependent, and we also prioritize our assets. So what we're talking about is long-term insurance as well as short-term insurance. Let me go into a bit more detail on the long-term insurance side. Most of us are prepared for the day that we are no longer around. How would you calculate how much you need available as capital to replace the income that would no longer come into the household? A good financial planner would be able to support you in determining what is the right amount of capital that needs to be available to make up for the income that would no longer be coming into the household. Generally, a factor is used, multiplied by your annual income to give you a sense of what the full capital required would be. But this only takes care of the biggest portion that we deal with when it comes to our financial planning, and which most people are most comfortable with, which is ensuring that if we are no longer around, there is money available to take care of those who remain behind. There are other aspects to consider when it comes to protecting your wealth. One of the first things to consider is, if I were to become disabled, in other words, unable to work, where would my money come from? As part of your pension fund, you may be entitled to certain benefits should you become disabled or should you contract a severe illness. And I encourage you to have a look at your pension fund statement as well as the rules to be clear on what the circumstances are that would trigger the payment either for disability or for trauma or severe illness, as we call it. But for those of us who work for ourselves, or for those of us who need to cater for a little bit more than may be possible through our own pension fund or through our employee benefits, it's important to look at how do we prioritize our own health. What happens if you contract a severe illness like cancer, heart attack, or stroke, but you survive this illness and you find that your medical aid is absolutely depleted because unexpected expenses were so huge that your medical aid was completely used for that particular health challenge that you were facing? How would you move forward? How would you deal with expenses that you find you now need to enter into because you need to adjust your lifestyle due to the fact that you've had a severe illness or for any other reason? There are a number of products available in industry that can help you to deal with changes in your health status, such as disability or severe illness or trauma, as we call it. We have two types of products. You have disability products that are lump sum products, as well as severe illness products that are lump sum products. These pay out once. These can be severity-based, so depending on the severity of your illness, a certain amount pays out, and that would be it. But how does one deal with the long-term consequences of the changes in your lifestyle that may exist or that you may experience as a result of having survived a severe illness or having survived a disability as a result of an accident, for example? In addition to the lump sum benefits that are available when you become disabled or when you contract a severe illness, there are also income benefits available. And these would allow you to deal with the longer-term consequences of not being able to work for one of these reasons. The income benefits are generally aggregated and cannot constitute more than 80% of your own income. I'm not going to go into the details of the aggregation, but a good thing to bear in mind is that your disability income benefits should not be more than what your monthly income was. In addition to the disability income benefits that exist in the market, there are also what we call income replacer benefits. The first one is what we call a sickness income benefit. A sickness benefit is payable at the expiry of a 7-day waiting period or a 30-day waiting period, depending on the type of product, for as long as you are booked off for any illness. A sickness benefit is not taxable. It is a capital amount that is payable to you, and your normal income would continue even if you were booked off. A second benefit would be what we call your disability income benefit. This one replaces your income, and as it replaces your income and is defined as income, it would form part of your taxable income and would attract tax, which is what differentiates the disability income benefit from the sickness benefit, which would not be taxable. The various products that we've discussed really offer you the opportunity to take care of yourself as a future dependent. It allows you to make sure that even if your medical aid is depleted, you would still be able to cater for health expenses and you would still be able to enjoy a lifestyle during retirement. Critically important to attend to these types of products as early as possible in your working career, because one of the hugest impacts is your health. We all know that since COVID, a lot of us find that we now deal with illnesses we couldn't even name previously. And these pre-existing conditions could add a huge load to your monthly premium when you are paying for life insurance and health products. You might find that a premium that would have been half the amount, say, when you were age 20, is now so much more expensive at age 30, either because you've contracted a severe illness in the meantime, and that pre-existing condition is now excluded going forward. So as far as possible, insure yourself as early as you can. Once again, here, a delay would be a denial. Long-term insurance products can have a bit of a bad rep. Some people feel that they're putting money into a pot and may never really have a claim for a severe illness or for disability. What do you do then? In insurance, the one thing we say, the one adage that remains true, is that prevention is better than cure. Yes, you would be putting money into a pot without knowing if you would get anything back except when you pass on. But the alternative of finding yourself unable to face a serious illness or the lifestyle adjustments that come with it is far too ghastly to contemplate. And I'd like to use an example here of a client I had who very recently had a very routine pregnancy, went in thinking everything would be fine, and coming out of that pregnancy found herself with some very serious cardiac issues. Thank goodness this client had a very good long-term insurance product and was covered for this severe illness, for which she then received a very big lump sum payout that she was able to use to cater for the unexpected medical expenses that arose due to her cardiac failure, and in addition to this, was able to make lump sum payments onto her mortgage bond and provide herself with other relief from day-to-day finances, having gone through this huge life event. So be careful for the reasons for which you do not look for a product, because you might find yourself out of pocket in a manner that can be very devastating to your finances and to those around you. Please remember to prioritize yourself and your health. When you look at your short-term insurance, you may also find that you are putting money into a pot that you may never get back. But the ghastly alternative to consider is that your car is bumped and you are unable to pay for it, or that your car is stolen and you are unable to pay for it. So critically important to plan to cover those risks which you are unable to cater for yourself. That would include expensive jewelry. It would include those kinds of assets or items that, unless they are insured, it would make a huge dent in your disposable income to have to replace these items. So again, here, prevention is better than cure. Look out for those assets that are important to you in the same way as you look out for yourself as a future dependent.